Hello and welcome to Crux Investor. We caught up earlier today with Warwick Smith. He's the CEO at American Pacific Mining. They employ a JV model. So we talked to them about the three assets that they have today and how the JV model is going to create value for shareholders moving forward. If you want our thoughts and opinions on that, you can find that at cruxinvestor.com/club, where you can also find detailed company reports and analysis. There are commentaries from experts from around the world on a variety of companies and commodities. We've got training courses to help you with your diligence. We've also done summaries of some of the interviews that we've done, in fact, all of the interviews that we've done, just to save you some time, because we know you're busy. And if you want to join a thriving community of investors sharing their thoughts and ideas with each other in a nice, safe, friendly environment, free from judgment, trolling and abuse, go and join them at cruxinvestor.com/club. Also, we'd love your feedback too. So do give us a like, be much appreciated. If your thoughts below, we get back to absolutely everyone. If you want to see precisely what we covered with Paul today, do take a look in the description below. Warwick, how are you, sir?
I'm good. How are you?
Not too bad, not too bad. Where in the world are you?
I'm based in Vancouver. Well, in Steveston to be exact, which is 15 minutes from the airport or so.
Very nice, very nice. I think I know where you are, actually. Yeah. Funny enough. Okay,
yeah.
Very, very good. And how are things down there in Steveston?
Listen, no complaints. It's a great part of the world to live. I miss traveling, I think, like everybody else. But it's been a good time to be home. I've got a 3.5-year-old son, so I've been able to spend more time with him and focused on the positive. That's been good.
That's a pretty cool age, I think. They're a
it's
bunch
great.
Of fun.
It's our first and only child for the moment, and I've thoroughly enjoyed it, minus the lack of sleep.
There is that. I forgot about that.
Yeah.
You eventually forget about it, and hopefully your wife does too. Right.
Yeah.
Well, we better kick off. Hear a little bit about your story. Okay. So new to us,
Great.
We've not met or spoken before, so I'm excited about this. So when you give us a 1-minute overview of the business, I'll pick it up from there.
Yeah, absolutely. American Pacific's a company took public in March of 2018. 3 high-grade assets in the Western U.S. The foremost asset is an asset called the Madison Mine down in Montana, under joint venture with Rio Tinto. They may spend up to $30 million US to earn 70% high-grade skarnet surface, porphyry underneath. Incredibly excited about that asset. The 2 other assets are based in Nevada. Tuscarora, high-grade epithermal system. That's the asset we started the company with. Got that from Novo Resources, and then Gooseberry, which is about 45 minutes outside of Reno. That's under partnership with a company called GRAD Global. So joint venture model, and they focused on the Western U.S. Excited for a bunch of drilling this year.
Okay, joint venture model, interesting one. Did you start off as that? But when did you start? When did this thing kick off?
March of 2018. So a terrible time to start a junior mining company. We were a little bit early into the cycle, but that allowed us to get some good assets. And look, I've been in mining since 1999. Love the people. Love the good people, I should say, in it. Love the assets. Got a great team of guys that I work around. So, it was early, but it was the right time with an asset that we really loved.
Right, and what was the plan? What was the plan with Tuscarora? Were you going to develop that, explore it, develop it, mine it? That was the idea, was it?
Yeah, that was the game plan. We came into it. I mean, to say that we were gonna mine it, we're explorationists. So for the most part, we'll look to develop these things and then transact on them. That's really what we look to do. And in the case of Tuscarora, came through Novo Resources when they were spending most of their time down in Australia. They had just drilled this asset, just outside of Elko. Quentin Hennig is the guy who runs Novo. I'm sure a lot of your subscribers will recognize that name. He had actually drilled this with Newcrest. He was when he was a young man. He was actually the guy on the drill. They put out great results on it, but the focus was in Australia. We were able to pick it up from them. Did a nice deal with them. We went and we drilled it ourselves in 2018. Got some good results, and 4 or 5. One of the mid-tiers came knocking, is what happened. So rightfully so, our board said, if you're talking to one, speak to them all. We did. And we ended up transacting on it with OceanaGold initially. And that sort of birthed this joint venture model. And then the addition of Madison expanded that when we picked that up because they were already in partnership with Rio.
I'm interested in how companies form and shape themselves, because you guys started at, you say, a sort of tricky time for gold. It was $12.50, wasn't it? I think that's
it was
for a long time.
Yeah,
but you talk about it being a nice deal, but you got to the point where you couldn't raise cash. You needed to speak to people coming in, or was it sort of welcome bids?
Hey, I'll be honest. It was a bit of both. It was difficult to raise money at the time. There is no doubt, especially for juniors, and when the shine was on cannabis and tech and everything else other than junior mining, as you know. So we had a great asset. We had good high grade results. Getting a little bit, getting some good volume within the market, and there was some excitement. But going out and raising capital was difficult. We got approached by one of the mid tiers. So when we did, I took it to the board. We discussed it. I'm quite familiar with the joint venture model. I helped found a company called Riverside Resources, which focuses on the joint venture model. So Ken Cunningham, who's one of our directors, ran Miranda Gold and focused on the joint venture model as well. So, we knew how to cut what we thought was a good deal. When that excitement came through, we thought this might be a good way to go. Let's have a discussion on it. We ended up doing it.
Right. Okay. So it wasn't
really
a big
did morph. It morphed into that,
Right, and that's dint of the feature of the market at the time, right? But you obviously have had to get a mid tier in. You must have had a ton of data, that you had acquired along the way. So at what point were you able to take it to, and then you couldn't? Were you able to raise capital?
Yes,
you could.
We did.
Right.
Yeah. So look, we raised $3 million when we went public. We transacted after that with Oceana. Did a couple of raises after that of $1 million and a half each type transaction. Then when we did the deal on Madison, that one's a little more interesting. We announced a $500,000 financing, and then the Casey Research Group put out a note to their subscribers that they should look to take part at like 10 a.m. on a Monday. And by the end of the day, I had a $5 million book, and the end of the week, I had a $7.5 million book. So things changed really quickly. We took $3 million there, just trying to keep the structure intact. But we've been able to raise capital. That has been a large part of my background. I started in investor relations, worked for Fortuna Silver from when it was a shell, and had good success there. Same with a company called Northland Resources, and focused on the capital raising side of the business. That really was my bailiwick. And then broke out with Riverside Resources and helped found that and put the pieces together and on from there. Okay,
right. So that's how you started. You segued or morphed into JV model. I get it. And you've got Madison, Tuscarora, and you've got Gooseberry and so forth, right? But you're selling at $9.5 million market cap today, right? So it's kind of small beer at the moment. Have you got cash today?
Yeah, we got about $1.5 million in cash, and then we've got about $1 million in securities. We burn about $100,000 a month. We don't spend a lot of money, but you're going to see about a $5 million US drill program from Rio this year. Plus, you're going to see drilling from GRAC as well on Gooseberry. So there'll be a lot of news, a lot of data, without us spending a lot of our own capital.
Totally get that. I would love you to explain the JV model, given your experience at Riverside, etc. Explain how you guys create value. Some of it's dependent on how much money's been spent on drilling and your JV partner's activity and success. But what are the bits that you're in control of? What are the bits you're sitting back and waiting for? How do you build it?
Yeah, absolutely. Look, I like the JV model. It was quite popular back in the early 2000s, and there was companies that had a great deal of success with it. The way that we look at it is, if you are a retail investor, if you are a small fund or a small institution, and you're looking at junior miners, you're ultimately looking to get involved in something that you hope to have that 10x fold return. So looking at ones that are involved with majors, mid-tiers, in many ways, they've done a lot of the due diligence for you. In that, I can tell you, when a Rio Tinto comes in or an Oceana comes in, the level of due diligence, they do a hell of a lot of due diligence. You have to have your ducks in a row for them to be able to review the project. They have to look at it and think to themselves, if we're going to invest our capital and take this project over all of the projects that are out there, if we find it, can we build it? And can we move this forward? So a lot of that due diligence is done. That's the upside of the joint venture model. For the issuer, so for American Pacific, we like it. Our background is in going and finding projects. I'm partnered with Eric Saderholm. So he was the former head of exploration in the Western U.S. for Newmont. They wanted 3 million ounces plus. He had seen a lot of things that were 500,000 million ounces. Didn't fit for Newmont, but fit great for us. So it's our job to go out and find good projects that we think can get bigger, and being able to sell that vision forward. if we can do that, and we can do that on a cost-effective basis, but then bring in a partner who can come in, spend their money on it, but we retain a percentage, good for shareholders. The downside is you're giving up a portion of it. In the case of Madison, they can earn 70%. So we're gonna retain 30%. Now, 30% of a Rio Tinto size target at a $10 million market cap, that can be lucrative. So there's the upside downside of it.
So you're not carried in any of these for your portion?
We are. Oh, sorry. We're full carried. So until Rio's got 3 opportunities to earn in, right? They spend $5 million, they can earn 55%. They spend 15, they can earn 60%. They spend 30, they can earn 70%. They can only earn it once. So we know they like the project. We believe they'll spend the full 30, earn 70%. Until then, we don't have to fund anything. At that point, then we have to earn it. So our downside is if we didn't, we retain a 2% NSR that's capped at 50 million US. That's your downside.
God, I was going to get onto NSRs and maybe come back to that in a second. And you talked about this model being successful in the 2000s. It obviously isn't successful at the moment, or we went through a period where it wasn't successful. What killed it?
Mm-hmm. You know, I think investors, or I think we went through a phase where mining has been so out of favor. It's coming back now. I mean, this last year has been, I mean, from the issuer standpoint, it's been a world better than it was the years before, as I imagine for you as well. And I think during that phase, it was difficult for investors to want to give up that further portion, right? They wanted to come in, see you drill it, see a big discovery. Great Bear is a great example. Drill it, see it go to, I think Great Bear is $12 or whatever, and it started at 30 cents. That's what investors were looking for if they weren't investing in cannabis or something else. So I think that took the sheen off of that joint venture model. Excuse me, became harder to finance them, etc. I like what we're doing. I like the projects that we have. I like our odds based on where our market cap is. So I think it works quite well for us. Happy to buck the trend a little bit.
Okay, interesting. Let's talk about the financing, because you talked about $1.5 million cash, $1.5 million securities. Your model is you got to go and find deals, and you got to evaluate them. Go, are they any good? Are they of a certain profile? So what is that certain profile that you're looking for?
We've focused on high grade assets in the Western US. That's our niche. That's what we're looking for. Obviously, we're looking for things that we can get into on a cost-effective basis. That's key for the model in our eyes, and then being able to transact on those. So, is it a project that's got a good size land package, has had good high-grade hits that you can then bring? Then you can attract the interest of a mid-tier or a major with. That's really what we're looking for. They're out there. For example, we previously in a previous iteration staked Black Pine, which is now with Liberty. Cal Everett's done an excellent job with it. Cal, Moira Advance, their whole team have done a fantastic job. We staked that. We picked up Deer Trail, which is now in Mag Silver, and they're doing an excellent job with that. So, we've been out and gotten involved in these projects either by staking them or negotiating what we think are good deals on them, and then being able to attract other companies that we can work with and use their capital to continue to move them forward.
Okay, but you and everyone else want to do that, right? So how do you finance that? Given your position, the cost of your money is going to be way more expensive. How do you compete on those assets? Are you going to be able to pick anything up soon? I mean, it's a pretty high gold environment, right? High copper environment to be trying to target some of these things that mid-tiers are going to be interested in. So what's the edge you've got?
Look, I think in large part the edge I've got is Eric. Eric's done a fantastic job, and he's been doing this for 36 years, and all credit to him. He's picked up some great assets along the way. I've got a fantastic board. Ken does a great job for us as well. Ken was the one who found Gooseberry for us. We staked Gooseberry, so that cost us $20,000. The cost of capital for us, we need to do more of this over the next while. And is get out and aggressively tell the story, let people realize, hey, look, Reservoir Minerals is a great example. With that discovery, Nevsun bought out their 30% for $365 million. It was an epithermal system at the surface and a porphyry underneath. Can that be Madison? We hope so, and if it is, that's a long way from 9.9 million. So the opportunity to succeed with this model is certainly there. We've seen that blueprint, and we've been able to pick up great assets in the past, and we have great assets in the portfolio today. So to answer the question directly, the team around us is our difference maker.
Right. Okay. So you've given us some of the numbers around Madison and the timing of that spend from Rio. What's Oceania going to be doing? Because they've again multiple projects. Are they focused?
Yeah. They're gone. To be we brought in Oceania for Tuscarora beginning late 2018, beginning early 2019. They came in. They did great work. They drilled it, drilled a few blind targets and hit and pulled out. We were very disappointed, but obviously they had issues down in the Philippines, and they actually ended up closing their U.S. office and pulled out of all the joint ventures. So those were tough times. At that point,
when was that?
In the 2019. Sorry, let me do my math here. They came in 2019. End of 2019. Okay. And it was tough. There was tough times in American Pacific. Seeing them go was challenging, and it hurt the market. At the time, thankfully, we'd been negotiating on Madison, which was a bit of a. There's a funny story as to how we got that, which I'm happy to tell if you like. But it was a prolonged negotiation, so we knew we were into that, and we'd be all right. But it certainly hurt. Since then, another group had come in to take on Tuscarora, but we announced last week that unfortunately their CEO passed away. Did you know Bob Baxter? He ran Norsemont previously. Great guy. Unfortunately passed away. So they'd made $300 and some odd thousand in payments, and we've ended up getting the project back 100%. So we're going to look to joint venture that again. They didn't even get on site before he passed away, unfortunately.
Right. Okay. So, and let's quickly then deal with Gooseberry, because I want to look at this as an entirety. So Gooseberry Silver Project, what's happening there?
Yeah, so we did a deal with a company called GRAC Global. It's a private company. They're going to go public here shortly. They'll drill it a couple months after they go public. We'll be the operator. So Eric will sit the drill. We've lined up a 15-hole drill program, 8 holes to start based on success, another 7 holes there. High-grade silver gold project, last in production, hard rock production, 1991. Then they went to shifting over to the tails because it was tough times. Hasn't been touched since 1994.
Right. New company, going IPOing, I guess, to raise some capital to allow you to operate it, right? So do you have any sense of what they're going to have to try and raise, or when that money is going to come to you to allow you to actually start some drilling?
Yeah, so they're supposed to go public here in the next 4 weeks, let's call it. Spoken to the banking team that are behind it. They're doing a good job of raising the money. I don't suspect it's going to be an issue. They're going to raise around $3.5 to $4 million. Excuse me. And they'll start drilling shortly thereafter that. I would suspect it takes 6 to 8 weeks before drills are turning after they go public. So sometime late Q2, I would think they will be drilling.
Okay, so what do you do? I get Madison, right? Obviously, that's got to be your flagship, right? And we'll come back to it. But Tuscarora and Gooseberry, you've got these assets. You kind of like something about them, but you need someone else to come in with their capital. GRAC is okay, 3.5 million, whatever the number ends up being, or upsized to 5 million, no doubt, in this market. It's not aggressive, but is it okay in your mind, going with these smaller companies? Would you not rather have a Rio in there? Would you not rather have an Oceania as was in there?
Yeah, there's 2 ways to structure these deals. And you ask a very good question. So look, the deal with Rio, first class, tier 1 partner, fantastic. Love that deal. Fought like hell to get it. So love that deal. Oceania was great. But they came in, I think they paid us a very small amount up front, and then they committed to $10 million worth of work that was going to earn them 60, 70%. I'm cuffing that because I think it was 70, but the deals that we've done with smaller companies comes back to cost of capital. They're quite willing to pay cash up front, good chunk of equity. So that's putting money into the till for us, allows us to run the company. So we like those transactions as well. And look, a lot of these good juniors they're the ones who get out and make these discoveries. They get out, they push in with the drill, they commit, they focus on that project. We like that. So I think a mix of the both actually works quite well for us, for a small company like us. As we grow, as we hope Madison evolves, that's going to become obviously the real primary focus, right? And that's where, but these other assets, we believe strong. There was a lot of debate about Gooseberry if we should drill it ourselves, even under the joint venture model, because we think we can have a lot of success there. We decided to do a transaction on it. Tuscarora, we did drill ourselves initially, but we're happy to bring in a partner to it. We love both those assets. We think they can become something. But taking those deals with juniors works quite well for us.
But this is what I'm intrigued by is again, the JV model has its pluses and its minuses, right? The big companies come in, you go, everyone's really excited. Look at their balance sheet. They can mine the heck out of this thing. But at the same time, it's got to meet certain criteria for them, or they're going to drop out, or they could drop out at various stages of this and still, be left holding a big chunk of this, which makes it less appealing for the next guy who comes along, right? So there is all of that potential downside that we need to be cognizant of in the decision making. And I appreciate the little guys, they're keen. It's their one asset. They've got to get going with this thing. They've got to make it work. And they're going to work a bit harder. They may not be as experienced and they may not be able to further down the line raise capital. So the JV model is a really interesting one. When it works, it really works. And when it doesn't work so well, it just takes a little bit longer, right? So to that end, are you not tempted to kind of get back on the saddle and actually start raising capital for yourselves, your explorers, and do some of this yourself now?
Yeah, we're tempted. I think we're constantly tempted, and I think we probably talk about it every day. there's the full, honest breadth of the answer. We have been. Here's the debate, the internal debate, and it is this: we strongly, along with Rio, believe in Madison. Rio's told us it's their flagship exploration asset for 2021. I mean, that gives us great excitement, great hope. So we're very intrigued by that. They're doing a significant program this year. It gives us a lot of excitement.
Do you know? I want to say this now. At this point, is like I've heard that from other people.
Okay. 100%. Yeah,
so it's my flagship. Not about your project, about their projects.
I get it. Yeah. I thought you'd heard about that.
You're my favorite child, though. Okay, got it.
I'm always hesitant to say it but
it's important. Let's say that.
It's an important project for them. It's a very important project for us. So we'll go with that. You throw me now. I've lost my train of thought.
I'm sorry.
Sorry about going back and finding assets for ourselves. We are in acquisition mode in that we've reviewed, doing one of these again, 50 to 60 assets over the past 12 months. We're constantly reviewing things, and came quite close on something recently that we didn't end up taking on. So, look, I like this joint venture model. I think it works well for us. If I found the right asset that I said we can go in and do a bang up job here, and the investment bank that we like looks at it and likes it as well, and it makes sense, I'm not adverse to that idea by any stretch. That is something that we would certainly consider doing. The point that I want to get across to the market today is how well the company can do based on Madison alone. Because that's the true, and that's the point. That's where, to be self-critical, I haven't done a great job of that yet, and I got to get that across.
Well, we see this a lot. We've seen people. We have interviewed a few other kind of JV model type companies, and it sounds great. It sounds great when the partner's working on it and they're spending the money and they're drilling the meters and the results are good, and that's all fine. But it's a very passive, unambitious approach to it. So in terms of the growth kind of component to your story, kind of feels slightly out of your hands in that sense. And I just wonder, what are your plans to kind of push that growth story? Do you find more assets quickly now in this environment where you can raise capital, or are you, just biding your time because you think Madison's all going to work out until it doesn't?
Yeah, no, fair enough. I think it's a fair question. The one point I will make is you can't find good assets quickly. That's one thing for sure, that you can find assets, but finding good assets takes time. We're doing that work. That's a lot of what the day to day is reviewing things and seeing if you can make a deal that makes sense. So we are reviewing it. We're certainly not against it. We're one of the things that in 2020, what I wanted to accomplish was to close the transaction on Madison and become institutionally owned. We did one of those two things, and that institutional ownership hasn't come yet. We've spoken to a couple of the good investment banks out of Toronto, and one of them took part in our last financing. But we want to grow so we can get more into that jet stream, and that may come via acquisition as well. So that's the other thing. So yeah, we're constantly reviewing, but we're picky. We like what we have, and we want to get something that's going to. If I want to do something, I want to have it take me from here to there, in short order, rather than something that I'm going to add dilution, and then it kind of takes me, slowly. So we're taking our time to find the right assets.
I mean, acquisition is expensive, but it gets you of a size that you can get noticed. So what are these institutions saying to you? Why are they not putting money in now? What are the things you need to deliver?
One of the true issues is we don't raise a lot of capital, right? And it's difficult at this market cap to go and say, okay, look, we'll do $10 million and let's get 4 or 5 institutions in here. That's a challenge. It's, we were a larger company back mid last year. We were about a $45 million market cap. Let's come down. It's trading around a $10 million market cap now. And that was based on, we'd raised money, it came free trading, and the guys were up quite nicely. And then compounding that problem was we paid 20 million shares for the Madison acquisition. It was a $2.4 million valuation at the time, which we felt was a good deal based on getting the partnership with Rio and the asset. When those shares came free trading, those shares came into the market. So it's compounded it. And then from there, it's traded sideways for a bit. And the market's hasn't been as good as it was before, for sure. So now that that stock has come out, now that we're getting out and telling the story a bit more, now that Rio's starting a big program, we're hoping to see that flag move back the other way. And when it does, I think we're in the discussion with those institutions who like the asset, some of the analysts who like the asset, and I think we're going to get there. But having Rio on the ground, also having that border open so that we can have analysts come down to site, that's going to make a big difference as well. So all those things are coming up here in the next few months.
Okay, well, that's what we should look out for. We'll start seeing some of those numbers coming out of the marketplace, see what that spend's delivering for you and for them, obviously. Stay in touch. Let us know what happens with those numbers, and let's see what it does for your share price. Because I think, it's a great model. Yeah, it's a great model. We've got great assets. We've got good partners. That partnership with Rio is great. The grades over there are cracker. They've got every reason to create excitement. So let's go see what they get. What are you gonna do with Tuscarora? Just remind me. Are you gonna flip that out? We're gonna flip it out. There's the press release on Bob's passing it coming back went out on today's Friday. It went out on Tuesday. We've had interest already, so we'll get a deal done there. Okay, excellent. Yeah, Warwick. Awesome. Thank you so much for your time today. Thank you. Have a great weekend and stay in touch. You as well. Thank you very much. Really appreciate being on the show.